the early take is we believe that the stress that the industry is experiencing is going to be what we refer to as an earnings problem and not a balance sheet problem. What I mean by that, Dom, is that when you go back to 2008 and 9, obviously it was very difficult for the banks during that time period. And not only did they lose their earnings during that period, but they also had depreciation of book value. You saw dividends cut or eliminated, and you saw disastrous dilutive capital raises to get those banks through the 08-09 down period. We don't see that at this point in downturn. This is going to be very severe. We all understand that. We saw the numbers yesterday, as you just described. Wells Fargo's numbers were severely impacted, as was JPMorgan Chase, due to the provisions for credit losses. And we think that as we go forward, we're working under the assumption that the third and fourth quarters will have economic growth following the fall off in the second quarter, which is why we say it's an earnings problem and not a capital problem. However, if somebody's in the camp, we're going to have a recession through the end of the year and into 21, then we're going to have a capital problem as well as an earnings problem for these banks.
All right, Gerard, I mean, there's been a lot of focus right now on the banks because of their capital return plans as well. We know that there have been banking authorities within the European side of things that are calling for many of those banks to suspend any kind of a capital return to shareholders. It's not the same situation yet here in the United States, though. What exactly can investors expect as these bank earnings progress about whether dividends are safe or buybacks are suspended?
I think what we're going to see, Dom, is that our regulators are approaching it much differently than what we've seen in Europe and in the UK. In Europe and the UK, as you pointed out, the banking regulators have required the banks to suspend not only stock buybacks, but dividends. We've not seen either of those come to fruition here in the United States. The banks voluntarily suspended buybacks a couple of weeks ago. But when it comes to the dividends, our banks are very well capitalized. When you look at the numbers yesterday, none of these banks are approaching any of the capital levels that would require you to cut the dividend. And we don't expect the regulators to come out with a blanket ban on dividends for the top 20 banks or the banking industry. We've never seen that before. Now, can we see a one-on-one situation where maybe one or two banks may have to cut their dividends? That's possible later this year, but not highly likely. And so we think the dividends are safe at this point. When we looked at the numbers yesterday that have come out, though the banks did not earn their dividends in the quarter, again, they have plenty of capital to get through here. And on top of it, I think you're going to see a slowdown in the growth in the balance sheets as we go into the second part of this year.
So Gerard, before we let you go, there's been a lot made about the effects of the coronavirus on small and medium-sized businesses in America right now. Talk to us about the outlook for those small and medium-sized banks that lend to those small business owners. Are they more at risk?
It's a really good question because the Achilles heel here is the small business community. They've been hit the hardest, and the smaller community banks support that community very well. The good news is, at least temporarily, it looks like there is aid coming to the small business community through the CARES Act. There's over $300 billion that has been directed to be in the form of forgivable loans to these borrowers, and the banks are orchestrating that. So at this point in time, it looks like the smaller banks will navigate through this, but they'll be hurt on earnings, no doubt about it. The real test will come toward the end of the year after the money is dispersed and the companies can survive even after receiving that money.